Welcome to class 27, and this class is on balance sheet. But before I proceed and share you the information regarding balance sheet, I want you to take a recap of the whole course. Okay. And when I say the recap, what we have studied in the very first module is the different intricacies of a stock market. I call it market microstructure. So you understand now a lot of things, that why people make money in market, why people lose money in the market, why this market exists, and so many other points. In module 2 you understood few basic things like basic of economics, mathematics, excel sheet, some terms and definition regarding industry and different sectors. Yes, they were all important. Now it is time to connect all those dots. After completing these two building blocks, you came to fundamental analysis. In fundamental analysis, we first learned about qualitative analysis, which I call checking the quality of the company. You learned one thing, that it is at the end of the day team of people who are going to run the company, and you need to check their intent, and then so many other things in qualitative study. Now, the important thing which you must have learned in qualitative study is like it's easy to identify good set of people, good set of business, if we keep our eyes open, if we see their historical record, even if we at least do some basic investigative journalism kind of thing about those companies and the sectors in which those companies are operating, you come to know a fair idea about quality of a company. And you must know the quality of a company. You must know whether the good people are behind the scene or not in that company, whether the company's fundamentals of business is strong or not, and then only you should go and jump into numbers. When we talk about numbers, you have numbers from three financial statements. This is what you know by now also. And those three financial statements were balance sheet, profit and loss statement, and cash flow. You learned about profit and loss statement already. But before learning profit and loss statement, in the start of quantitative analysis, I shown you some representation, numeric representation of comparing two, three different businesses, or comparing those businesses with fixed deposit. Fixed deposit also give you return. These businesses are also supposed to give you return. You also know by now what is the book value of a firm, right? But then I took a different order and I explained you about profit and loss statement first, and then I told you that we will go and learn about the balance sheet. And here we are into this class, balance sheet, where I'm doing a recap of this course and taking some time to ask you to connect the dots. And the dots are this. Yes, you have to find out the quality of the company, and then you have to look at the numbers. And what you really need to understand is you can always compare numbers. You can compare the return of one company operation, or one company profitability year by year to FD also, and to its competitor also, and you can all compound it in different columns together and see that in how many years basically one company makes sense to invest even at higher price than book value. Right? So book value is one term which you know, that if you liquidate a company, the money which you take home is your book value. No company will offer you, no good company which is making a return of more than 15, 20%, 14, 15% even, or 12, 13% even, will offer you its shares, or their share will be available. Very few companies will be available, and if they are available, again you need to go to check, and if you find everything is good, that is what is called the value buying or the value investing. When you know that something is having a good worth, market is not giving that company that worth, the price which this stock should demand, and you go and identify and invest much before everyone else, will be called the value investing. And when I talk about these numbers, and when you learn on these numbers and learn about these companies based on these numbers, what you are trying to do actually is do the value investing, right? So now connecting the dots of profit and loss statement to balance sheet. So in profit and loss statement, what I told you, that a company must report profit, and not only that, it should report profit, the profit should keep on increasing every year. Then only the power of compounding will come for the help for this company to grow big. This power of compounding thing is something which I have mentioned probably 20 times till now in this class. So power of compounding will come and help a company only when exponential growth in sales and exponential growth in profit is there. Well, qualitative analysis is done. You know how to do it. You have seen the profit and loss statement and saw that these companies are not either posting profit at all, or even if it is posting a profit, it's in a very linear fashion or a zigzag fashion. And you don't see any magic happening in the very near future, so you filtered them out. Or you took some contrarian bet. Contrarian bets are when I have taught you, when you have learned it, when Warren Buffett have told you that power of compounding work and sales growth should be there, profit growth should be there, and still you find there is no profit growth and no sales growth, but you still take a call to invest into that company, you take a contrarian bet. You imagine, you visualize, you foresee that okay, till now company is not doing well, but I see that because of certain changes, these companies profit will also exponentially grow, and its sales will also incrementally grow, exponentially grow. And the most important part is the sector in which this company is operating, that sector has enough space for this kind of sales growth. For example, if the market size of one medicine itself is 50 crore, I mean, this is a very rare disease, and only one that medicine which your company is going to, going to make, then you know that the market size is only 50 crore. So you cannot keep on exponentially growing for next 20 years. Because when the exponential growth will come, within 4-5 years, you may occupy 50% of the market. And that time, even if your company have the feasibility to exponentially grow, because market size is not big enough to grow. So you are wise enough. I want to tell you that when you are doing it before investing into stock market, you are a wise investor and you are a value investor as well. But the point here is, once you have understood this part, that you have to see the sales growth and profit growth, and you know that you will be able to see this in profit and loss statement, one more thing which you may want to see as well, which is what is the worth of this company. It is posting a 250 crore profit, but it is posting on 1000 crore, 5000 crore, 10,000 crore, or 1 crore. This is what you must be interested. You should be interested to find out, right? And balance sheet will tell you that. It is not the profit and loss statement which will tell you that, but it's the balance sheet which will tell you that. And that's why it is important for you to understand balance sheet. But the problem here is balance sheet has been always projected as a very complex financial statement to understand or to decode. Well, if quality wise a company is not good, they are not truthful to its investors, they may have a fabricated balance sheet, and even if you know how to read it well, you can't do much. But then if you trust these companies, and that's why you have learned qualitative analysis first, and you trust the number they are reporting, then you must go and see the numbers before taking a call of investing into that company. So this lecture on balance sheet will be again divided into two parts. Part 1 is where we will learn in the most simplest manner balance sheet, and then in part 2 we will see the balance sheet of few companies and try to make some conclusion. Right, the first 10 minutes or 15 minutes of this class I asked you to connect the dot, because at this level I want you to start investigating companies. I want you to be confident enough to go and start seeing the numbers, start seeing the character of the companies and the quality of the companies. Okay, you do not have to wait further. I know you may be waiting for ratio analysis, which you will learn, but those are the shortcuts. Remembering PE or EPS definition and then going and identifying companies is nothing but shortcuts. That will not help you. We will cover that. We will cover that and you will understand it. And when you understand it at rest time, when you hear about those numbers, it will be easy for you to do certain filtration. But when you are going to do the value investing, it is very important that you become friendly with financial statements. So let's talk about balance sheet now. And to start the balance sheet class, I'll give you a very small example. The example is like this. Let's say you are a 30-year-old person. All your last 10 years you have worked, and I assume you are a decently paid middle class person, and don't feel offended that I'm saying middle class person. I mean, a decently at the age of 30, one self-made person, let's say he's in a bracket of middle income group and get paid 1 lakh rupees per month. He saves some money, and for 7-8 years of savings, let's say he saved 30 lakh rupees. And as whatever values our culture, what we do, the very first thing is we buy a house. So let's say you bought a house worth 1 crore. You have 30 lakh only. So you took 30 lakh rupees. You put your 30 lakh rupees, and nowadays loans are easily available. So you took a loan of, let's say, obviously you have to take a loan of 70 lakh, right? Now, you know your worth now. I'm sure you know your worth now. Your worth is 1 crore, right? No. 1 crore is the asset which you have built. Asset is something which you own. Liability is something which you owe. So you owe 70 lakh rupees to the bank. However, you have 1 crore worth of house, but your net worth is 30 lakh rupees, isn't it? This is what is your money, your net worth. Tomorrow, for any reason, if you need to sell this house, you can sell it, pay off the loan, and what you will be left with is 30 lakh rupees. And that will be called your net worth. Well, balance sheet is this only. This is your individual balance sheet. Okay. This is your individual balance sheet. You obviously don't make a balance sheet like this for yourself. You just keep it in your memory that, okay, you have this house 1 crore worth, but then 70 lakh is a loan on your head. So you remember this loan part, you know. And you never obviously intend to find out your own net worth, but then hindsight, we all know the net worth of ourselves. Let's say you are going to buy a house and you know that this person is having a loan of 70 lakh rupees. And the house worth is 1 crore. How much you will give to this guy? Not 1 crore, but you will say, okay, fine. If you're not going to settle off the loan, it is me who has to pay the loan. And I'll give you 30 lakh rupees, because 30 lakh is the worth of this house actually, which you are paying me. The house worth may be 1 crore, but the transaction value will happen at 30 lakh. Well, this is the balance sheet. When a company does something like this, they are called balance sheet. And what you need to understand here is balance sheet is very simple. This is balance sheet. Yes, this is balance sheet. So someone, I'll delete this row now. So someone decided to put his own 10 lakh rupee and start a business. He did good business. 3 years passed. Now let's say this 10 lakh, we have seen enough example in past, became 25 lakh. He obviously has to run his family, spend and everything. So all he was able to do was able to set up this business and was able to save some money as well. And money he saved is 25 lakh. He started with 10 lakh. 10 lakh was his equity. I know equity is one word which many of you might not be very comfortable at this point of time. What you know about equity is equal to share, is equity is equal to stock. In balance sheet, equity is the very initial time, the capital which promoters or founder put. This is what you can remember for right now. Okay. Once we will proceed with this class, there will be few more things which will get included in equity. But for the time being, let's say this person started the business in 3 years back. After 3 years, he was able to save some money and he made it a 25 lakh rupees business, right? Well, this 15 lakh rupees or this business which is having 25 lakh worth is, let's say, a proprietary business for him. He converted it into a private limited now. And he put all his money, this 25 lakh rupees which he have saved by making 15 lakh profit and 10 lakh initial capital, he put this money into the private limited company as his own contribution. How much? 25 lakh. But then he wanted to expand the business and he know that 25 lakh rupees will be not enough. With an inclination of raising 75 lakh rupees more, he started this business and he raised 75 lakh rupees. Now, out of this 75 lakh rupees and 25 lakh rupees, he will buy offices, he will buy equipments, he will buy everything which is required to run the business, and he will keep some cash in hand so that he can have a smooth operational business. So let's say everything, the cash, the building, material, machine, everything which he has bought with this two money combined together, and that is, let's say, 1 crore total. So this is the format of the balance sheet. Something which you have to understand here is, as the name suggests, it is made in such a way that both of the side needs to be balanced. Many of the time you will remember asset is equal to liability is what is the balance sheet. Well, yes, plus equity on the right hand side. This equity is the initial capital of this firm, and then let's say he went to the IPO stage as well and raised another 50 lakh rupees in IPO from, or let's say, 50 lakh rupees. So, and that 50 lakh rupees again will be used into increasing the asset because he is raising this money to expand the business. For the business expansion, this money will go into building assets, keeping money in that kitty through where they can spend operationally by paying salary or wherever it is required. They need to keep the cash as well. So this 50 lakh rupees which they have raised through IPO. So once the share IPO has come, doesn't matter that share is trading at what price, company will not get any benefit out of that immediately. In longer run, obviously the company valuation will increase, and if the share prices have increased, they will have better, positioning in the market in terms of raising debt and many other stuff. But at this point of time, when they raise the IPO, the equity portion will become 25 lakh plus 50 lakh, which is 75 lakh rupees. Again, let's say till this point of time, they have not paid off any loan. The loan is still the same 75 lakh rupees. So what you can see that the asset has become 1.5 crore. What other thing can happen? A company a company is supposed to make profit. When company make profit, they pay interest, they pay taxes, they give dividend, and still there will be more money left with the company, which will be called retained income or reserves. So you have to remember this term reserve. When we will look at the balance sheet, I'll remind you again. But at this point of time, that reserve or retained earning in first year of operation after bringing the IPO is, let's say, again another 25 lakh rupees. So we can add this 25 lakh also. Well, let's say he has just paid the interest and not repaid the principal yet. So the loan is still 75 lakh. Well, what you can see here is 50 lakh, 25 lakh is the promoter fund, 50 lakh is through IPO, 25 lakh is the retained earning through the profit. So what you can see that it becomes 1 crore, isn't it? 25 lakh, 50 lakh and 25 lakh. 1 crore is now the equity portion. Loan is still the same, which is 75 lakh rupees. And here, obviously, the money which has came via all these things are money which is cash in hand, and cash in hand is the part of asset. So again, the total asset will increase by 25 lakh rupees and it will become 1.75 crore. This is how a balance sheet evolves. And this is where you have to understand to find that what exactly is the net worth of a company at this point of time. Because only when you know that a company actual worth is 1 crore and it is posting a profit of 40 lakh rupees year by year, or the net profit is, let's say, 25 lakh rupees, then only you know that this company is actually growing at 25% against 6% of the FD, or this company is growing at 25% against one of its competitor, which is only growing at 18%. And then again, I want to connect the dot that you will take the profitability number from P&L statement, net worth of the company from here, and the way I would like to again recall you, business cases and power of compounding, investment choices based on different returns. So if you go and refer to this Excel sheet or this class itself, you can do this exercise altogether, where you have the net worth of the company by subtracting liability from asset. Total asset minus liability will give you the actual worth of the company, and on that worth you can obviously that there are two pieces here. One is what I'm calling again net worth, okay, and another is called the intrinsic value of a company. Obviously, when a company is growing at 25%, what they have is this track record of business, intangible assets like brand equity, which they have built, and a business which is giving a consistent return of 25%, and the worth of 1 crore. The net worth, everything which this company have already built by themselves or the investors have put in. So that 1 crore along with this business performance where they are giving 25% return will be finally the intrinsic value of that company, which will be much higher than what this 1 crore is. Obviously, because 25% is a good rate. You have seen in the previous examples in power of compounding. But point here is, you do not have to confuse yourself or make an assumption that balance sheet is a very complex financial statement. You can see that if I even delete everything, or all you have to focus is, if you focus on this, asset is equal to equity plus liability. Equity you have understood in all the format. At the end of the day, you have to find out this equity and then see that at what rate this equity is making return in terms of net profit, which you can get from the P&L statement. My simple request in this class would be, do it for at least 10 companies. Even if you go and jump to the second part of this class where I will be explaining you about different balance sheets, you first pause here and try to extract things from screener.in, see the balance sheet of few companies and try to see whether you are able to understand the reserve and surplus from there or not, the equity portion from there or not, able to subtract asset minus liability or not, and then see that at what rate this money is growing. Don't look at any ratio, don't look at EPSP or anything else. Don't look at the valuation of the company or try to look at the valuation. Just try to do this simple exercise that, okay, this is the total worth of the company at the current balance sheet structure. This is the profitability which they have posted in last year. And on the basis of that, I see that how strongly or efficiently this company is making money. Well, this is my way to do things. Your way to do things could be different, but the idea is you have to understand financial statement and you have to take out the important information from the financial statement. And I'm not going to make this financial statement balance sheet chapter lengthier or going to include more terms into it, which I'll do into the second part, because all I want you to take away from this class is asset is equal to equity plus liability. This is how equity progresses, and you have to find out this equity portion and take number from P&L statement from net profit and try to see how exactly this company is doing in terms of its peer against its peer and FD. Try to do this exercise and your balance sheet chapter will be over here itself. However, for example, and to understand and do some analysis, we will do with few balance sheets in the next class, part 2 of balance sheet. Thank you.